In the coming days, weeks, and months, you're likely going to hear quite a bit about a recession indicator that has successfully predicted every recession over the last 50 years. Now, you're going to hear quite a bit about this indicator because right now this indicator is flashing red, indicating that there might be some market turmoil, a potential recession ahead. So what is this indicator? What does it mean for your retirement? And what should you do about it? Let's get into it. To understand this indicator and why there's so much focus on this recession signal, it's first important to understand something called yield curves. Now, fundamentally, we understand that we earn a higher interest rate for locking money up for a longer period of time. For instance, you earn a higher interest rate on a 5-year CD than you do on a 2-year CD. Well, the same type of idea applies to treasury bonds. All a yield curve is essentially mapping these interest rates out. So we take everything from a 3-month treasury bill all the way to a 30-year treasury bond, and we map out this relationship. The longer the time frame, the more we expect to earn on that given bond. And so here's what a normal yield curve looks like. At each given duration, as we go up the duration ladder, we expect to earn more on that given bond. But at various times, historically right before a recession, this yield curve can become inverted. An inverted yield curve means that you can earn a higher interest rate on a shorter term bond. Now, this doesn't really make any sense because remember this idea of the longer that we lock money up, the more we expect to earn. And so an inverted yield curve essentially breaks this model. We're earning less on a shorter duration bond. Well, ultimately, this is a signal that investors have less confidence in the future. Typically, during times of economic turmoil, we see interest rates drop. This is due to central banks dropping interest rates to spur on economic growth and trying to lift us out of that given economic turmoil or recession. And so essentially what happens when the yield curve inverts is investors are signaling that they have less confidence in the future. They believe that interest rates are going to fall in the mid and long term. Thus, we see the yield curve inverting and mid and longer term interest rates falling below short-term interest rates. Now, this is not some kind of tea leaves or crystal ball type indicator. It's rooted in the fundamental economic cycle. There is a basis for why the yield curve inverts. And historically, it's been incredibly accurate, successfully predicting the last 9 recessions. The most commonly tracked interest rate pair is the relationship between the 10-year treasury bond and the 2-year treasury bond. Now, going back to the start of the 1990s, we would have expected on average to earn 1.15% more by investing in a treasury bond than we would have invested in a 2-year bond. But there have been 6 times since 1990 that we've seen this relationship invert, where you would have earned more on a 2-year treasury than you would have earned on a 10-year treasury. Now, if you're tracking the years on the chart on the screen, you'll notice something quite alarming when this interest pair inverts. To show this, I'll overlay the US stock market drawdown over this interest rate pair. And what you'll see is before every given major stock market drawdown since 1990, we saw this interest rate pair invert. The stock market correction of 1998, the tech bubble in the early 2000s, the global financial crisis of 2008, and even as recently as the COVID crash of 2020. Each of these stock market crashes was preceded by this interest rate pair inverting. And within the last month, we've seen this interest rate pair invert once again. So should you be panicking? Should you be moving all of your retirement assets to cash, to safety? Let's put the brakes on for just 1 second. There are a lot of details that create some gray area around these yield curves, and these details are very important to understand. First, although the 10-year and 2-year interest rate pair is most often quoted, there are many more interest rate combinations. For instance, why would the 10-year and 2-year interest rate pair be significantly more valuable than, let's say, the 3-month and 5-year interest rate pair? Or maybe the 10-year and 30-year interest rate pair. So what happens when one of these inverts, but the others don't? Is that still a recession signal? This happened in 1994 when we saw the 5-year and 30-year interest rate pair invert, but yet there was no stock market crash because of it. So rather than just tracking a random pairing, let's map 10 interest rate pairs to gain a more accurate picture of the full yield curve. And we would expect the more yield curves that are inverting, the more accurate signal we gain for a given recession that's looming on the horizon. And historically, this is exactly what we've seen. On the screen, you'll see that when we have more than half of these interest rate pairs that are inverting, we gain a stronger recession signal. This happened before the tech bubble in the early 2000s, before the global financial crisis of 2008, as well as before the COVID crash of 2020. Now, for those investors that are watching this video and getting a little bit nervous, it's worth pointing out that as of recording this video, only 30% of those 10 interest rate pairs are currently inverted. So this is a little bit weaker of a signal for if there is a recession on the horizon. Further, just because we see a yield curve inversion doesn't mean that a recession immediately ensues. In fact, there has been historically quite a long lag time between that yield curve inversion and that economic turmoil to follow. Over the last 6 inversions between the 10-year and 2-year pairing, we've seen an average of 19 months from the time that inversion happens to the time that recession happens. The shortest was 7 months, the longest was a whopping 35 months. So that's a long time to wait. So as an investor, you may want to pause and rethink moving to safety immediately when you see this yield curve inverted. And when I say you might want to rethink, I mean you might want to really rethink moving to safety immediately when the yield curve inverts. Because as you see on the screen, we've seen some incredible growth between the time that we see the first inversion signal and the stock market decline. And so not only is there a lag from the inversion signal, but there is a ton of growth to be had historically within that lagging period. In fact, the average 1-year growth after an inversion since 1976 is almost 10%. Now, this is slightly less than the normal average that we see on an ongoing basis, but nonetheless creates some gray area around this yield curve indicator and shows that this indicator isn't an exact indicator. It's not an exact science. Now, in the coming days and weeks, as you see headlines around this recession indicator, you'll rarely hear about the gray area. Ultimately, with the media, what bleeds leads, and the media can't be bothered by those less important details. But we see that there is a lot of gray area around this recession indicator. So how should investors navigate? We recommend caution forward. You don't want to move all of your retirement assets to safety, but you also don't want to be full steam ahead with your retirement portfolio either. There could be reason for increased market volatility ahead, and we want to make sure we're prepared. This is a great point to review your retirement plan and make sure that regardless of what we see ahead, you're prepared both financially as well as psychologically. It's important to have a retirement portfolio that balances both growth as well as safety. Unfortunately, many retirees are unable to find this balance in this low interest rate environment. Now, we recently recorded a training that I'm going to link to right here that shows how you can find this balance by rooting your retirement portfolio in a math-based approach. Again, click on this video right here, and always remember you don't need more money, you need a better plan. Thanks for watching.